What's up everyone, it's Kadi with Money Investing. In this video we are going to be talking about one more company, one more stock that is now trading very close to its net liquidation value, a concept we talked about on the channel earlier in another video. So shout out to Ben for mentioning this company during our live stream and in the live chat. So we're going to break down exactly what this company is, of course, talk a little bit about their earnings, because they just released their first quarter 23 earnings, and talk a little bit about their balance sheet and their forecast as well. So I hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you want to get access to all the benefits, all the alerts, all the options alerts, trade ideas, swing trades, and of course all the private live streams along with all the other benefits as well. And we've also started a new text channel which will directly send to your phone if you turn on notifications, and you will literally just get it on your phone. You can get up to speed with all the analysis and the updates as well. So the link's going to be down below if you're interested in joining us. So a company that we are going to be talking about today is going to be Rivian Automotive. So this right here is going to be the company. And yes, Rivian is not profitable, so you'd be surprised that we are covering this on the channel on a more serious basis, but it is trading at $14.11, up just over 1.8%. But I really want to go over the balance sheet for the company and the risk-reward trade-off that this company offers at the moment. So when it comes to their earnings, they reported $1.25 in adjusted EPS. That was down from $1.59, so a narrow loss, and a revenue was a beat at over $661 million versus $652 million. Now, as we know, the electric vehicle business is really capital intensive, right? It's not easy for any company to actually be profitable and of course execute at the same scale as Tesla has been able to do that. But you'll notice that EV maker had over $11.8 billion cash remaining as of March 31st, down from $12.1 billion at the end of 2022, and capex for the first quarter was $283 million versus $418 million same time last year. So we are seeing capex come down. We're also seeing a 6% cut announcement in the workforce for about 900 employees, which is going to be another set of potential efficiencies that can translate into better profitability. And CEO mentioned our core priorities for 2023 are unchanged. The team remains focused on ramping production, driving cost reductions, and developing the upcoming smaller R2 platform and future technologies, and delivering an outstanding end-to-end customer experience. So Rivian said on April 3rd that it built 9,359 EVs in the first quarter and delivered almost 8,000 vehicles to customers. Both numbers were down from fourth quarter, so quarter over quarter we are down, and as a result of the planned factory downtime as the company upgraded assembly lines to incorporate its new line new made models as well. So when it comes to the actual numbers, as we already know that Rivian is in the electric vehicle truck business, so that's what they pretty much produce. They're mostly focusing on trucks at the moment. And if you come over to the most important thing, which is their balance sheet, so I'm gonna trickle all the way down here. So this is gonna be their balance sheet. So as of March 31st, 2023, they're sitting on about $11.2 billion worth of cash. So even if we take this number alone, right, even if we take just the cash number, because you have to understand when we're calculating net liquidation value, there's only cash that has a 100% recovery rate, right? Everything else we can't take into account 100% because accounts receivable, let's say 157 million, there's probability that of that 157 million, they're not going to get paid 100%, right? They're going to pay, let's say 60% or 75%, but they're not going to get every single dollar out of their accounts receivable. When it comes to inventory, they're sitting on about $1.8 billion of inventory. We know that this not all this inventory is going to sell through, and it's actually higher than same time last year, or actually their fourth quarter. So this is quarter over quarter numbers. So 1.8 billion. We understand that not everything's going to actually sell through when it comes to their inventory. Same thing is true with property, plant, equipment. Property, plant, equipment is kind of valued at $3.8 billion right now. But over time, as it depreciates, as the depreciation is kind of added back, the market value is going to be different, right? Market value is going to fluctuate. Of course, when you're looking at property, plant, equipment, the factories or the land, land doesn't depreciate, right? So of course, with factories, you can write that off as depreciation on your balance sheet, on your income statement. But at the end of the day, the market value is going to still be either steady or increase because it's going to appreciate. It's an asset. Over time, it's going to increase. Operating lease assets and other non-current assets. So all in all, only cash has 100% recovery rate because it is literally cash. Everything else is going to have, I want to say 75 to 80% recovery rate, except for property, plant, equipment. So what we're going to do is we're going to safely assume $15 billion here for their total assets. $15 billion because accounting for $11.2 billion of cash, a little bit of a lower inventory, a little bit of lower accounts receivable, a little bit lower operating lease, other non-current assets, and then accounting for property, plant, equipment. We're going to safely assume that at least $15 billion is what the company has on its cash. Now, when it comes to total liabilities includes your current liabilities and your long-term debt, your accounts payable, your accrued liabilities, everything put together. How much does the company actually owe? And that is coming in at $5.4 billion. So if you simply take into account, $15.4 billion minus 5.4, to make things easier, we're looking at $10 billion. $10 billion is going to roughly be their net liquidation value if today Rivian were to basically go out of business and be sold. $10 billion is what they have in assets after all their liabilities are paid off. So that's literally what, at the minimum, a company that's acquiring Rivian or any buyer would be looking to pay. At least that much, right? $10 billion because that's what they have in the bank, right? That's what they have in terms of cash and assets. And right now, Rivian's trading at $13.25 billion. So it's very close. It is really, really close to its net liquidation value. And something that I mentioned in one of my other videos, and if you simply take into account cash and don't even account for the actual net liquidation value, 11.2 billion, and the company is trading at 13.2 billion. So it is really just trading at its cash value. The market's not pricing in any potential for this company whatsoever. Zero potential is being priced in for this company at the moment. It's literally trading at its cash, almost at its cash value. And it is very, very rare for these companies, for any company rather, to be trading at its cash value because if you come over to Finviz, and this is a screener that I ran through during our live stream, and if you simply come over to this metric, price to cash, right, which is just a ratio that we use to understand what's the market cap with respect to the cash on the balance sheet. And if you do this, let's just say under 2, you're going to find very, very few companies. Right now, you've got 1,248 that's under 2. And if you do the math, 1,248 divided by 7,500, that's only 16%. And I can tell you that most of them are financial companies, right? Fintech or financial banks. There's a lot of companies, maybe in the healthcare and biotech sector, but a lot of them, if you come down to, let's say, under 1, you're just not going to find any companies, right? 638, and a lot of them are going to be for finance, especially if you go over to a market cap, which is a little bit over $2 billion. Then you're looking at only 63 companies, right? 63 companies out of 7,500. That's less than 1%. And most of them you can see that are financial. You may find some in the small cap, mid cap, few $100 million market caps, or even $20, $30 million market caps. And that's fine, but they're also very speculative, and markets can manipulate that stock very easily. So I like to look at that threshold for at least over 2 billion and price to cash under 1, and you can find barely any companies out there. So most of them would be financial companies or companies that are heavily indebted. But for Rivian, we're looking at a negative net debt. So again, if you come over to their peers, you're looking at negative net debt because they've got more cash than their all liabilities, not even just debt, all liabilities. You've got a negative $9.76 billion worth of negative net debt here, with current ratio over 5.4 and quick ratio over 4.81. So you've got a company that's trading pretty much at its cash value. That's why the risk reward is, in my opinion at least, starts to become a little bit better as Rivian continues to sell off. I mean, I would still prefer to come down to, let's say, $12, $10. I would love to buy it below $10 billion because, then at that point, I'm just basically buying a $100 bill for $90. Or a $100 bill, I'm buying it for $95. You get the idea, right? You're getting the same amount of value for a much lower price. That's what you're paying once you start buying it below the cash value. Now, one thing that does kind of concern me a little bit is basically the share dilution, right? That's something that I don't want to see happen over and over again, because the company has been issuing a lot of shares, and that is a very, very unfortunate situation because if they constantly keep diluting shareholders, that's not great. That's something that I've mentioned before, and that's gonna continue to dilute your stake in the company, and as a result, once the company eventually starts to become profitable, we're going to be equivalent. We're going to be entitled to a smaller piece of the whole pie when it comes to profitability. So that is something that does, is a big red flag for Rivian at the moment. But overall, all in all, whether the company executes or not, $10 billion, looking at their net liquidation value, I would be very, very patient, might even sell some cash secured puts on them to look at this company. And I would be looking at this support at $11.75, closer to $10, because that I consider to be a pretty decent floor, at least in the short to medium term, considering that Rivian doesn't kind of burn through all their cash, and just, of course, increases and takes on debt, because that's when the thesis will change if the cash amount goes down and the debt starts to go up. We also have to remember that Amazon also owns 17% of Rivian, so they've also got that backing of a very, very large cap company. So I'm sure that they're not going to let it fail, so to speak. So they're gonna do something with Rivian that makes sense over the long term. So the risk reward profile is all I'm really looking for. We're not assessing here the growth of the company or the potential for the company, because the future is uncertain. Nobody really knows how well Rivian's going to execute. They're still moving in the right direction, so that's good. But the point of this video is to really assess the risk versus the reward, and that is to say the risk is it's trading almost at its cash value, and the reward is all the untapped potential this company has, which is obviously significant or could be significant over the long term. So let me know your thoughts down in the comment section below. Let me know what you think about this company from a valuation standpoint. Let me know what your thoughts are. One red flag that I will point out to is the share dilution. That's one of the reasons, or that's how really the company has been able to increase its cash balance on the balance sheet in the first place, is by issuing a lot of shares and raising money through the capital markets. So that is something that is a big red flag and big concern for Rivian. But let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below. Happy investing, and I'll see you all in the next video.